Hello, everyone, and welcome to this webinar celebrating the 5 years of Gulaq line of small cases. And I'm your host, Sandeep. And today we have with us Sandeep Tyagi, who is the chairman and the managing director of the ST Group. And the ST Group runs a line of small cases called Gulaq. And, first things first, Sandeep, thank you for taking time out all the way from Florida. And congratulations on, completing 5 years on the small case platform. So over to you. How does it feel completing 5 years? And what a 5 years these have been, to be frank. We had the ups and the downs, everything.
Absolutely. Thank you so much for having me here. It's a pleasure. And you're right, both for small case, for Gulaq and Estee, and most importantly, I think the overall story of India, retail investor financialization has been an amazing journey. So it's great to be here celebrating 5 years on small case platform, which is also the story of 5 years of tremendous growth in the overall investment awareness, investment experimentation, and engagement by vast number of people across the country.
Lovely. So if you have to look back and at the past 5 years, are there, what were those moments which stand out? I know 2020 was a very difficult year, both for the world and as far as markets are concerned. But if you have to kind of think about what were those moments which stood out for you, I would love to hear that from you.
Yes. So first of course, was the launch. We launched in May 2020, about 5 years ago. And that was, if you remember, the COVID time. And very, very quickly, we started getting a lot of traction, a lot of engagement. We started doing monthly webinars. So the second milestone for us was to start getting engagement with people. We reached very quickly to 18,000 plus active customers and investors. AUM started going above several hundred crores. That was the third milestone. The fourth one for us was when small case started ranking the best performing and the most invested portfolios, which we were very proud to be featured in many, many quarters, months, and years. So that was a big milestone for us. And the fifth one is our gross annualized return has been 45% over this 5-year period, which is just an incredible performance of the market. I don't want to take all the credit for our strategy, but in this period, it has been a great time for people to invest in the markets. And the benchmark itself has done 24% annualized over this 5-year period. And we are very happy that we were able to deliver 45% annualized over this period, so exceeding the benchmark by 21% a year.
Lovely. So specifically, Sandeep, how did the portfolios perform during the COVID crash and the subsequent corrections which happened? Any thoughts on that?
Yeah. So if you look at year by year performance of what we did, actually the outperformance was very consistent every year. In calendar year 2020, Nifty was rebounding. We launched in May, so it had already corrected in March and April quite a bit, and then May onwards it was rebounding. So the index did 52.4% return in calendar year 20 after our launch. We did 74.4%, so that was incredible. Again, 22% outperformance. In 21, if you look at it, there was a big bull market. Overall, the index did about 30% return, and we did 63%. So we outperformed by about 33%. In 2023, there was a lot of volatility. The index only did about 3% return. If you remember, there was the market were reacting to the Fed put on what was happening in the US markets. And in that navigation of the volatility in the global markets, we delivered 21% against the index at 3%. In 2024, there was a market correction. There was sharp outflows of FII, and the market did about 15.2%. And we also got caught a little bit in that, but we were still able to outperform by about 0.6%. So we delivered 15.8%. Now this year, we have had a rotation of mid and small cap. and there has been a impact and correction in these particular segments, and we are about just positive at 0.2% for calendar year 25. Market is also just about flat at 1.8%. So year by year, if you look at it, when there was a lot of volatility in 2022, in 2020, we did very well. When there was a lot of bull market and aggression in the market in 21 and 23, we did very well. It's in the recent slowdowns, we are holding fort and trying to stay steady as the markets stabilize and we know what's going on with the small and mid cap, along with the global volatility around tariffs and what's going to happen in the global trade scenarios.
Thanks, Sandeep. That really helps. It's great to know that the portfolio performance has outperformed rather in most of the times, and even this year, as you say, it's almost at par with the benchmark. Now, a few things which come to my mind when we talk about portfolio performance is specifically what kind of volatility has the portfolio seen, and if you could share a bit about what we generally talk about in terms of Sharpe ratios, and also if you could explain as an investor, how do I look at Sharpe ratio of the portfolios?
Yeah. So if, first of all, in terms of overall metrics, if somebody had invested in Gulaq 1 lakh rupees when it was started, they would have had, at this point, 6.7 lakh rupees.
Which month was that, Sandeep?
May 2020 to now.
Okay.
So fine.
All right. Okay.
And Nifty would have also done quite well. There would be 3+ lakhs. So we would have been over 2x returns of Nifty. Now, if you look at the metrics that you asked about, which is Sharpe and standard deviation and volatility,
Correct.
Our Sharpe is about 1.6, whereas Nifty this period also has had a good Sharpe of about 1.2 or so. Now, just for investors, Sharpe is a measure which compares the return that you are generating versus the standard deviation of those returns, which is risk. So how much does the return vary year to month to month, period to period, versus what is the average amount of return that you are able to generate? So people use it to, what are you taking in the market? Because if you were writing lottery tickets and buying, generally playing satta or some kind of a gambling investment strategy, you may have very high returns, but you are also taking very high risk.
Taking a lot of risk, yeah.
It becomes an important thing, and we generated a Sharpe of 1.65 versus the index of 1.2. And this is in this period of 5 years where the returns have been very, very good overall, as I mentioned, about 24% annually for Nifty. On average, the index delivers, half a Sharpe. So the volatility tends to be about 2 times what the average return is. But this has been a good period, and we have been able to outperform it in this period as well.
Lovely, thanks. So, so the next thing that comes to my mind is you've been on small case for 5 years now. You would have, and you literally seen thousands and thousands of investors invest, come out, and some of them stick to their plans, some of them don't. So, if you were to think about it from an investor standpoint, what could people do to get the best out of investing models, specifically be it quant models or otherwise? So some thoughts on that, how to think about it as an investor.
Sure. So I think the first thing that we learn very quickly about retail behavior, and I'd read it theoretically, but when you go through it in the actual experience in the markets, it becomes much more clearer to you as a concept. So performance chasing is one of the things that the investors who do not do very well end up doing in the market. What is performance chasing? It means that I'm looking constantly in what fund is doing well, what small case is doing well, and then switching from one to the other based on what I see happen in the last 1 month or maybe 1 to 2 months. There's a story very famous of a fund called Magellan Fund. In 1990, it delivered 70% return, and investors rushed into it, lured by the stellar performance that they delivered. However, the very next year, the fund underperformed, and the investors abandoned it. As a result, over the time period of about 10 years, the Magellan Fund delivered about 25% annually. However, the average investor who invested in Magellan Fund lost money because they always came in when there was high performance in the past 1 to 2 months or quarters, and they left immediately after bad performance. So they bought high and sold low. And we saw that a little bit in Gulaq Gear 6 as well. We had a very impressive return, 1 month return of 12.6% in January 2024 against the benchmark, which only did 1.9%. And we got a rush of investors coming in. However, in February, we didn't do as well. We underperformed the benchmark by about 6%. So investors exited, and some of them called and said, this is not working anymore. Even though over 2 months period, we were still outperforming. This kind of performance chasing ends up creating unnecessary costs, and almost always is less advantageous to the investor than investing, picking your advisor and managers and sticking with the product for some period of time. We suggest at least 3 years, but at least 1 year is required for any kind of performance to start showing in a measurable way. The other thing we noticed was people sit on the sidelines a lot. This is what we call timing the market. They ask the question when I do webinars or investor meetings. The most common question besides which stock I would recommend is it a right time to invest in the market? And we saw that in May 2020 to December 2020, when everybody was afraid due to COVID and people were just sitting in cash, and we missed the biggest bull market where, our portfolio went up 74%. When on the other hand, at the end of 2024 till about September, October, the going was so good, a lot of people were investing. And we could see that the small and mid caps were becoming pretty expensive, but there was a much higher momentum, more than what would be an appropriate allocation to get into these funds. As a result, when the correction happened in small and mid cap, a lot of people who had come in had an adverse return. So this timing of the market, trying to predict what the market will do next, is not a very good
behavior
in the markets. And overall, what I would say is the place where quant investing, which is what Estee and Gulaq stand for, shines is when you do not make emotional decisions, when you're not driven by greed and fear, when you are driven by systematic, disciplined way of evaluating markets and investing, then you'll do very well.
Sandeep, other thought that comes to my mind is because when you interact with investors, especially people who invested with Gulaq, are there any, out of ordinary expectations that they have when it comes to quant? Do they think it's going to work across markets, or anything that you have come across?
Yeah, there are lots of misconceptions about quant that we see when we address investors in meetings or webinars. One is a lot of people think that it's a black box strategy. They feel like they don't know what's going on. Now,
what if you could explain? I'm sorry.
Yeah, black box strategy means it's some kind of a mysterious, secretive algorithm and nobody knows what's going on. At some level, it's true. Of course, we do not publish the exact factors and algorithms, but we share a lot of information on what type of factors we use. We share what was our attribution to momentum, value, quality, those kinds of things we do provide in our webinars on how we are doing. So in that sense, the quant investing is very, very systematic and transparent in terms of what exactly it's going to make, decision it's going to make. Now, compare it to a fundamental investor. You don't know what's going on in that fundamental investor's mind. Why are they making that decision? They may have woken up in a bad mood, may have had a headache, and while commuting to the office, they got stuck in a really bad traffic. And when they get to the office, they make certain decisions because of the frame of mind they are in. So in some sense, there is black box in a fundamental investor as well, because you don't know what's the process going on. But in quant investing, what is true is the method and the system I'm following today is the method and the system I'm going to follow tomorrow. So I have a systematic, research-based methodology which is well documented, followed down to the letter T, and applied period after period in a consistent way. The second misconception is Quant is only about technical fundamentals. And some of my colleagues work only on single factor. There are a lot of momentum funds out there. So that's a single factor. We are only focusing on one factor, momentum, which is a technical factor. However, in ST, we work with hundreds of factors which are across technical and fundamental. And not just that, we also have macroeconomic, participation in index. Those kinds of factors are also included in what we build. So we are approaching this from not just technical, but also fundamental and macro view. The third view, a misconception is quant funds tend to be only backward looking because they rely on backtesting. Now, while it is completely true that the premise of quant investing is that the history will repeat itself, that we will look at long periods of history and then decide for this period, for this type of macroeconomic environment and pricing in the market, what portfolio would work well. That's how we come up with something like that. But when we incorporate in it the things which are broader than company specific, so we see what is happening in a sector, we see what's happening in the overall economy, we see what's happening in the macro economic factors like interest rates, debt ratios, currency movement, gold prices, energy prices, then you are able to get a more holistic view. And we are not just then looking backwards, we are looking at scenarios from history to see what is most applicable and coming up with a balanced view. You may have momentum when the macros are going down. Now, that may not have happened in the past, but when you weigh these two things together, you're able to create a new scenario.
So, Sandeep, do you think, sorry to interrupt, but do you think history repeats itself because you're talking about scenarios?
I do think history repeats itself very often, and certainly it rhymes all the time.
Okay. So, and that's where these models come in. They figure out when it's rhyming and kind of they're better prepared to take advantage of those scenarios.
Yes. Like the last criticism I've heard is that I hear many times is that your funds are too diversified. You're taking too many positions. Now we tend to take 15 to 20 positions in our portfolio, and the way we think about it is you are trying to perform better than the market. The market for us is 500 stocks in NSE and BSE 500. So when we say we are going to take position in 15 stocks, we are actually saying we are not taking position in 485 stocks. So we are actually quite opinionated in terms of where we want to hold position. A lot of people are looking for the silver bullet. This is a great idea. I'm going to put in a lot of money in this one stock or two stocks or three stocks. Quant investing is not about that. It's about creating a portfolio where different factors will help you position it and benefit from various trends in the market. And therefore, some amount of diversification is very important.
Got it. Awesome. I actually like your perspective, Sandeep, where you said that it's quite possible that discretionary managers are as black box, or at least they are gray, if not black. So that's a great takeaway, for me and other investors. So I'll move to the next set of questions, which I have about the future. So how do you look at the future? So one of the first questions is, are there specific themes which you see, which could be important themes to invest in? How do you see that, especially in the context of markets?
So, look, in quant world, we don't like to give too many predictions on what's going to happen. What we want to position ourselves is we are here to help you navigate through all kinds of markets using the best information we have from how the economy works. Having said that, there are certain things that we see in the market at this point. The first is India is well positioned. Overall, the GDP growth has been revised upwards for 23-24 to 9.2%. It has been the highest in 12 years. And a lot of the macroeconomic, fiscal, monetary metrics are looking very conducive for a good growth environment. The second is there is boost because there has been some tax exemptions for incomes up to 12 lakh that will inject significant amount of disposable income into the spending stream, and it will boost GDP further. Third, we think there is global uncertainty which will continue to play a big part in the Indian economics. So you have the US tariff risk. The world is going from a globalized multilateral trade environment to balkanized, where there is protectionism, and how we play in that environment. There are scenarios in which India significantly benefits because US and China are at loggerheads, to others where everything becomes so contained within each economy, and US just wants to do its own thing and Europe wants to do its own thing, that it constrains us. So we don't know what's going to happen, but that risk is very significant in the upcoming time period. And on aggregate, we think it will probably be positive for India. Now, we also see that the growth forecast, especially from many other experts, because we don't really do macro forecasting, is that the growth will continue to be above 6%, maybe 6.5%, 6.7% for next 2 years, which is a very, very robust, good number. So when you combine these things, it looks like the good story for India will continue to work. Now, economic growth does not always directly translate into stock market performance. The stock market tends to be sometimes outpacing the economic growth. You have bull markets where the stock market runs up a lot faster than what the economic growth is, and then it corrects to come back. So it doesn't mean that we are going to have steady 15% growth every year. We'll have years where we'll have 30, 40% growth, and then we'll have years where we'll have some correction. And that's why you need a systematic approach to go through this.
Got it. So do you foresee some kind of a correction in the coming years? I know that's not a question which you may want to answer, but any thoughts given that the past several years, I mean 6 to 7 years, have been extremely positive for Indian markets. So is it going to be a lull for this year and the coming year? Is that something?
Yeah, that's one question I'd have to plead ignorance in terms of being able to predict. I don't have a crystal ball. I do know that significant correction has happened in the market segments which were overvalued. Is still more than the average value at this point, the mid and the small cap. The large caps are generally fairly valued, at least in the historical context. So there can be further correction in the small and mid cap, but there can also be growth and momentum that will start building up again because some correction has already happened.
Got it. So I have one of the questions talking about economy and the world at large. You are based out of the US, where which is kind of the mecca of tech. So this question is that there are two parts to this question. One, when we look at AI and ML, all the conversation which is happening, what kind of an impact that you see it would have on economy, jobs, and so on? So that's one side. The other side is, as an investor, is it going to make my investing better? From putting on your quant hat, do you see it's going to make things better? So these are like two different questions that I have in the context of AI and how it's evolving.
Sure. So let me address one by one. In the question of would AI change the job scenario, the answer is undoubtedly yes. I've been through some of these major cycles, whether it was the internet bubble, outsourcing wave that happened in 2000s. And I see this one as similar, if not bigger, than those kinds of changes. So I think the type of white-collar job where your job involved moving information from one place to another, combining information from a couple of different places to come up with a decision, those types of jobs will completely get displaced over a period of 10 years or so. I think what is going to happen is the same thing that happened to manual arbitragers, which used to sit on a screen and trade between NSE, BSE, to stenographers who used to sit in government offices and type out letters on manual typewriters. Those jobs are all gone. And I think that's going to happen to a very large portion of white-collar jobs over the next 10 years. Now, at the same time, a lot of new jobs will get created in this new world. Now, so it's not like that the number of jobs have gone away because we have PCs. It's not that number of jobs have gone away because we have outsourcing and other things. It's just that the shape of the economy and the work has changed. So that's definitely going to happen, and going to happen in a very, very big way in white-collar information management, information related jobs. When it comes to use of AI and ML in the world of investment itself, I'd break it into two parts. The first is breadth of information consumption, and AI and ML is going to help increase the speed and breadth of information absorption that every investment manager can do. Today, you can summarize an investment report in 5 minutes. You can put it into ChatGPT and know what is the key points. You can look at an annual report. You can look at the quarterly filings. You can process all the information about the company that's coming through social media and news media in real time. And that never used to be the case. People used to have armies of research analysts. Brokers used to have to digest that information and put it in investment reports. Now that's available to everyone on the tips of their finger, sitting on their laptop. So I think absorption and speed and breadth of information is going to increase dramatically, which will make all of us better investors. The second thing where I think AI and ML will have a very big role to play is the explanation of investment processes to an average investor used to be very limited. Why? Because it was either done by your neighborhood LIC or UTI agent, or your uncle or a friend who themselves may not have been very sophisticated financial investors, or your bank manager who was trying to get their bank quota met in terms of doing some 3-in-1 investment accounts. That world, I think, will change dramatically. So ST has built a digital advisor where there is online on your phone, you have access to all our thinking, and you can ask any question. And you can do an analysis of your portfolio, ask any question, and that kind of democratizes and makes it available to everyone. It's kind of like having Google search, but for investment, available to you all the time. So now knowledge about what to do with investments, any doubts you may have, any questions, recommendations, becomes available to you in the comfort of your home over the weekend, sitting on your own couch and understanding what's going on and what you can do with your investment. That, I think, is a much bigger change that's going to happen, because this type of advice was just not available to average person simply for the cost reasons. It's too expensive to make it available to everyone who is maybe investing a few lakh rupees. Of course, people who are investing 5 crores, 10 crores had that advantage through wealth advisors, but not an average small investor. That is going to be another big change that's coming in our way.
So this is the, the second, when internet came in, they were talking about democratization of information, but actually it did not happen the way we expected it. But this time around, this is kind of, AI is taking it to another level, and we expect more such, democratization of knowledge to happen this time. Is that what you're saying?
Yes. See, what internet and Google did was it democratized information.
Yeah.
Because you could ask, what is the price of wheat in US? You could ask, what is the price of gold in Dubai right now? And all of that was available to you instantly. What is changing now is what to make of it. So to say, how does my portfolio get impacted based on what's happening with the US tariffs? That question Google cannot answer, but AI. So we are moving from facts to advice with this revolution.
Got it. So, so other thing which comes to my mind is, with all these things changing, Sandeep, do you foresee, the way ST operates and the way, or maybe some new small cases that you may launch, which are better positioned to deal with the next 5 years?
Yeah. So we at ST strongly believe that more products is not the answer. Actually, one of the things that I joke about with my colleagues at Small Cases. At some point, if you have thousands of small cases, have you really solved the problem? Because there are hundreds of stocks, and if there are thousands of ways of selecting them, then the investor still has the problem on what should I do? Because the reason they're coming to you is the investment world is overwhelming. So ST believes in having very simple products. We actually have one portfolio for going long onto the equity. Now we have several gears that we do, but they are simply asset allocation between equity and fixed income. That's all we are changing. Between gear 1, 2, 3, 4, 5, 6, the change is in asset allocation between fixed income and equities. We did launch a portfolio for small, mid and large cap funds, but it uses the same methodology that we do for our overall portfolio. So we are not likely to launch a lot of different products. Typically, it is a new methodology in AI or ML. We think these things are tools to do our work better. The work remains the same, which is how to help investors make better returns on their money. But the tools available have now become better and faster. So we will definitely incorporate them, both in terms of doing our research and coming up with the recommendation, and in terms of explaining that process and explaining our advice to the investor through the digital advisor that I just mentioned in the previous question.
So with that, Sandeep, we come to the last part of this particular webinar, and this is going to be a rapid fire round, and I'll ask you 5 questions, and you are not allowed to think for more than 5 seconds before you answer. So the first one, one financial term or concept which you think is highly overrated.
Return. I think everyone focuses only on return and they ignore risk. There is no return without risk, and the balance between the two is the most important part of doing good investments.
Right. So return it is. And, if you had to choose between value or momentum, what would be more closer to your heart?
Momentum works, particularly India, but value is the way to build long-term wealth.
My third question, between conviction and diversification, what wins in the long run according to you?
I think the world rewards diversification with a disciplined approach more than conviction. I think in conviction, it's very hard to know. You could be right and lucky for many, many years and then one day wipe out everything if you're not diversified.
I agree. So the fourth question, one non-finance book that made you a better investor?
Yoga Sutra.
Lovely.
This is the old Indian traditional book on the philosophy of yoga, and it teaches you how your mind works, what is true knowledge, and how can you become a better person who handles greed and fear, which are our two enemies in being a good investor.
Thank you. By the way, I just want to plug in that for those of you who have not read, Sandeep has written a lovely book on investing and the whole investing process, which ST uses in terms of gear. It's called The Little Book of Big Gains, a guide to investing wisely. So if you have not read it, if you're not ordered, please do that. With that, I jump into the fifth and the last rapid fire questions. Bull market versus bear market, which one has taught you more?
Bear market has taught me more, but I like bull markets better.
Lovely. Thank you so much, Sandeep. That was great. Thank you for taking time out. And once again, congratulations to you and the entire ST team for completing 5 years on small case. And here's to the next 5 years and more. I'm sure there's a lot to see.
Thank you so much, Sandeep. And thank you so much to the small case team. What a wonderful experience it has been to be here at the time when the whole country awakened to learning about how to make investments in stock markets and grow their financial security. Happy to be on the journey and look forward to the next 5 years.
Likewise. Thank you.